Welcome to The Explainer. Today, we're diving straight into a masterclass on personal finance, the architect of wealth, time, compound growth, and independence. If you're looking for a clear, actionable blueprint to finally stop working for your money and start making your money work for you, you are exactly where you need to be. Let's break this down. Picture this. Two friends, both 25 years old. They earn the exact same salary and have the exact same dream of total financial freedom. Now, the difference between them isn't luck, it isn't who is smarter, and it's not even their income. It all comes down to one single choice. Friend A decides to start investing a little bit of their income right now, today. Friend B looks at their budget and thinks, you know what, I'll just wait until I'm making a bit more cash. So, a decade goes by. Friend A has been quietly investing every single month. Friend B finally lands that higher salary and starts investing at age 35.
So who actually wins this race? If you ask most people, they intuitively assume that friend B, the one who started later but is probably throwing much larger chunks of cash at their investments, is going to easily catch up and pass friend A. But spoiler alert, they usually don't. And understanding exactly why they don't is the absolute master key to everything we're going to talk about today.
Let's get into Section 1, the compound growth snowball. Because here's the thing. The most crucial factor isn't just how much money you're investing, but how much time that money actually has to grow. You've probably heard that Albert Einstein called compound interest the eighth wonder of the world. Now, whether the legendary physicist actually said that or not, the jury is kind of still out on that one. The math itself is undeniably a wealth-building powerhouse. Let's look at the actual mechanics of how this works. Step 1, you invest $100. Step 2, that $100 earns a return. Simple enough, right? But step 3 is where the absolute magic happens. The following year, you aren't just earning a return on your original $100, you're earning returns on your previous returns too. Your money literally acts like a snowball rolling down a massive hill. It starts off small, it moves kind of slow, but as it gathers layers of snow, or in this case layers of interest, it accelerates dramatically over the decades.
Now, I've got to be real with you. At first, this progress feels painfully slow. You're going to look at your accounts and think, is this even doing anything? But you have to be patient because eventually that growth begins compounding on itself so incredibly fast. This is exactly why people say the first $100,000 you save and invest feels so much harder to reach than the second $100,000. By the time you hit that second milestone, time has literally become your silent business partner doing the heavy lifting for you.
Moving on to Section 2. Investing is not gambling. We need to completely rethink what we mean by risk. And let's start by busting the biggest myth out there. Listen, if you're throwing money at random stocks just because some influencer on social media promised they're going to the moon, or you're just chasing the latest hot tip, you are not investing. You're speculating. Honestly, you're just hoping for a winning lottery ticket.
Real investing? That is a disciplined, long-term process of building a highly diversified portfolio. While speculators are out there frantically searching for the needle, true investors just buy the whole haystack. They use broad market index funds that track massive groups of companies. By capturing the historical upward trend of the wider economy, that diversification actively neutralizes the impact of any single company failing. Success here isn't about luck. It's entirely about patience.
And look, the market absolutely does not move in a straight, perfect line upwards. Volatility is basically the toll you pay for the ride. Some years are going to be fantastic, and some years are going to sting. Market declines are a totally normal part of the process. The winners aren't the people with a crystal ball trying to predict every little dip. The winners are the ones who consistently invest straight through the turbulence, good times and bad.
Which brings us to Section 3, beating inflation with consistency.
A lot of folks think avoiding the market entirely is the safe play, but they are completely ignoring a silent wealth killer. Let's say you take 10 grand and hide it safely under your mattress for 10 straight years. Sounds perfectly safe, right? A decade later, you pull it out and yep, it's still exactly $10,000.
The physical cash hasn't vanished, but what can it actually buy you? Way less. Its buying power has been completely hollowed out by rising prices. While having cash in a basic savings account is absolutely crucial for your emergency fund, your long-term wealth has to be put into assets designed to outpace this guaranteed loss of purchasing power. Saving alone is just never going to be enough for those long-term goals.
So how do you actually step into the market and fight back against inflation when the news is always telling you the sky is falling? Wealthy investors use a little trick called dollar cost averaging. So many people get paralyzed waiting for the perfect moment to invest. They think things are too risky or uncertain, so they wait, and years of opportunity just pass them by. Dollar cost averaging fixes that. It's just the disciplined habit of investing consistently over time, completely tuning out the scary headlines. Sometimes you'll buy high, sometimes you'll buy low, but building that long-term habit matters so much more than trying to time the market perfectly.
All right, Section 4, Redefining Retirement and Independence.
We really need to toss out this totally outdated idea that retirement magically begins the second you hit 65. That is just an arbitrary number. The reality? Retirement starts the exact day your investments can generate enough income to fully support your lifestyle without you having to clock in for a paycheck. It's not about your age at all. It's 100% about reaching financial independence.
To actually get to that level of independence, things like 401ks, traditional IRAs, and Roth IRAs are gonna be your best friends. You probably know the basics of these already, but the key is using them as a legal tax shield. Protecting your money from the drag of annual taxes, that acts like absolute rocket fuel for your compound growth over a couple of decades.
And finally, Section 5, Achieving True Financial Freedom.
This is where the whole blueprint comes together. You've really got two distinct pillars here. Saving acts as your shield, protecting today's money and giving you peace of mind. Investing acts as your engine, building tomorrow's wealth and giving you real growth. You absolutely have to have both. Saving without investing means you're slowly losing to inflation, but investing without saving, that means you might panic and sell off your assets the second you have a medical bill or a flat tire.
But when you balance those two out and give your investments the time they need to compound, something absolutely incredible happens. Your money is going to start earning more money than you could ever make just by working your day job. That is the tipping point, guys. That's when you stop working merely to survive and your money steps up to do the heavy lifting. That is what true financial freedom looks like.
Remember those two friends from the very beginning? Every single day you sit on the sidelines waiting for the perfect time is a missed opportunity for that compound snowball to gain momentum. So what small step are you going to take today to build tomorrow's independence? When are you going to finally decide to let your money start working for you? Thanks for tuning into this explainer, and I'll catch you in the next one.